Do you ever feel like no matter how hard you work, you're just stuck in the same place? Well, you're not alone. Today, we're diving into the truth behind America's debt trap and why millions are struggling to break free. Now, let's start with the numbers. As of the end of 2024, the total household debt in the United States reached a staggering $17.94 trillion, according to the Federal Reserve Bank of New York. This debt encompasses various categories, each contributing to the financial strain on American families. Compared to a decade ago, this is an increase of nearly $5 trillion, showing just how rapidly debt levels are rising. If this trend continues, household debt could surpass $20 trillion within the next 2 or 3 years, placing even more pressure on middle and lower income families. Adjusted for inflation, today's debt burden is significantly higher than it was in the early 2000s, making financial mobility harder than before. Looking at historical trends, consumer debt levels are now comparable to pre-2008 recession figures, but with higher interest rates. While the housing bubble was one of the key drivers back then, today we're seeing an across-the-board debt crisis, affecting mortgages, auto loans, credit cards, student loans, all at once. The 2008 financial crisis was triggered largely by irresponsible lending practices, particularly with subprime mortgages. When housing prices collapsed, millions of homeowners found themselves underwater, leading to mass foreclosures and a financial collapse that required unprecedented government intervention. Credit card balances have hit a record $1.17 trillion, reflecting a significant increase from previous years. This surge indicates that more Americans are relying on credit cards to cover daily expenses. The average household carries over $7,000 in revolving credit card debt, resulting in thousands of dollars paid annually in interest. Credit card interest rates have surged to an average of 21%, making it even harder for consumers to pay off balances. Historically, credit card interest rates were lower, but post-pandemic inflation and Federal Reserve rate hikes have pushed them to unprecedented levels. Meanwhile, banks and credit issuers have profited massively, collecting tens of billions of dollars in interest payments annually. If interest rates continue to rise, borrowers could see credit card APRs exceeding 25%, creating an even more crushing cycle of debt. Credit card debt has been a growing issue for decades. In the early 1980s, credit cards became widely available, allowing middle-class Americans to borrow more easily than ever before. However, this also led to rising delinquency rates, and by the early 90s, credit card defaults had skyrocketed. The parallels between that era and today's debt crisis are striking. Easy credit card access, followed by economic downturn, has historically placed consumers in financial distress. The student loan crisis is no better. More than 43 million borrowers are stuck in loans that they never fully pay off, with total student loan debt reaching approximately $1.77 trillion. The average federal student loan debt balance is $38,000, while the total average balance, including private loans, may be as high as $41,500, with interest rates ranging from 4 to 7%. Many borrowers end up paying far more than they initially borrowed. Delayed homeownership, postponed family planning, and limited career choices are just a few of the consequences faced by those burdened with student loans. Prior to 2005, student loan debt was more manageable due to lower tuition costs and better repayment terms. However, the rapid increase in tuition fees, combined with reduced government funding for higher education, has left borrowers in a worse position than even before. If tuition costs continue rising at their current pace, student loan balances could exceed $2 trillion within the next decade. Additionally, fewer young Americans are pursuing higher education due to fear of student debt, which could have long-term implications for the U.S. workforce and economic competitiveness. Historically, student debt wasn't always such a burden. In the 1970s and 1980s, the cost of college was far lower, and more students could pay for their education with a part-time job while in school. However, with the government making unlimited money available to anyone who wanted student loans, universities just started bloating with tons of administrative positions, building up their campuses to attract students, just creating a rising cost in tuition over time. Additionally, government cuts to higher education funding in the 90s forced universities to shift even more costs to students, leading to skyrocketing tuitions that we're seeing today. The structural shift in funding contributed to the student debt explosion, making higher education less accessible than it was for previous generations. The past teaches us that debt-fueled economic expansion is often followed by painful contractions. Whether in the 70s, 80s, 90s, or 2008, financial downturns were frequently preceded by periods of easy credit, over-leveraging, and rising household debt burdens. The question now is whether policymakers and consumers will take lessons from history to avoid another economic collapse. On a broader scale, the national debt has reached over $36 trillion, surpassing the country's total economic output. This growing debt raises concerns about long-term economic stability and the potential burden on future generations. Interest payments on the national debt alone are projected to exceed $1 trillion annually within the next few years. Rising interest rates have exacerbated the debt burden, leaving Americans paying more in interest on mortgages, auto loans, and credit cards, further straining household finances. Even a slight increase in interest rates can cost taxpayers billions in additional payments. Compared to other major economies, the U.S. carries one of the highest debt to GDP ratios, making the long-term sustainability of government borrowing a growing concern. Now, medical debt is another major factor that cannot be ignored. Over 100 million Americans are dealing with some form of medical debt, forcing many to cut spending on essentials like food and clothing, or to completely deplete their savings just to stay afloat. The rising cost of medical care has only worsened this crisis, leading to a vicious cycle of debt accumulation. The medical industry's rising costs are expected to continue, potentially pushing even more families into financial distress. Now, many people don't even realize that medical debt is the leading cause of bankruptcy in the United States, far exceeding student loans or credit card debt. Adding to this financial strain is the rising delinquency rates. The percentage of consumers falling behind on credit card and auto loan payments has increased significantly. As of late 2024, credit card delinquency rates have reached 3.23%, up from 2.97% in 2023, signaling growing financial distress. Now, auto loan delinquencies have also surged, with nearly 6.1% of auto loans now at least 90 days overdue, the highest level in over a decade. Rising inflation and stagnant wages mean more Americans are struggling to keep up with the minimum payments, increasing the risk of defaults. According to CoreLogic, mortgage delinquency rates have also started to creep up, though they remain lower than the historical highs seen during the 2008 financial crisis. If this trend continues, we could see a wave of foreclosures in the coming years, mirroring the housing crash of 2008. Another major concern is underwater loans, when a borrower owes more on the asset than it's worth. This issue is particularly evident in the auto and mortgage markets. With used car prices dropping nearly 19% since 2022, about 1/3 of auto loan borrowers now have a negative equity in their vehicles. This means that they are trapped in loans that exceed the current market value of their vehicles, making it nearly impossible to sell or trade them without taking a financial hit, having to pay out of pocket. Mortgage borrowers are not exempt from this trend, as the share of seriously underwater mortgages, where the loan-to-value ratio exceeds 125%, has increased to 2.7%. Some regions, particularly in high-cost housing markets, have seen a larger spike in homeowners falling into negative equity. In commercial real estate, nearly 20% of loans are now at risk due to declining property values, further indicating broader economic instability. If property values continue to fall, we could see an increase in strategic defaults, where the borrowers walk away from their obligations due to negative equity. To truly address these issues, we might need some more government policies to address predatory lending, and really we need financial literacy, financial education programs available to the masses. We should force people in middle school, high school to learn financial education, because right now, kids grow up, they go to school, and when they graduate, they don't know how to exist at all in the real world. No one taught them. Consumer awareness is another key factor. Many borrowers don't fully understand the terms of their loans or the long-term consequences of high-interest debt. Addressing these gaps could make a significant difference in the term of long-term financial health of American households. Historically, periods of high national debt have led to policy shifts. After World War II, for example, the U.S. had a debt-to-GDP ratio of over 100%, but strong economic growth and responsible fiscal policy helped bring it down over time. However, unlike post-war period, today's debt is driven by consumer borrowing, entitlement programs, and rising healthcare costs, factors that don't resolve themselves as easily as wartime spending did. The American debt trap is real, but you don't have to be its next victim. The system is designed to keep people financially stuck. But with discipline and the right strategies, you can fight your way out. The key is to act now. Every month you wait, the more you owe. Take control, make a plan, and break free from the cycle of debt for good. Exploring debt relief programs, increasing financial literacy, and making smarter borrowing decisions can all contribute to long-term financial stability. The number one thing you can do is subscribe to my YouTube channel because it's free and you'll get all the financial education content that your heart can desire. So if you enjoyed this video, please give it a like, subscribe, and leave a comment down below. What do you think about the debt crisis? Thank you so much for watching, and I'll see you next time.